The closing bell rang on Wall Street. Traders went home. The sun set on New York, and while America slept, $800 billion vanished. It happened on the night of February 2nd into February 3rd, 2026. Asian markets opened first. Tokyo, then Hong Kong, then Sydney. Red numbers flooded the screens. By the time European markets opened, the selling had accelerated. London, Frankfurt, Paris all plunging. And when American traders woke up and checked their phones that Monday morning, they saw something that made their stomachs drop. Futures were down 4%. The Dow was set to open down over 1,500 points. NASDAQ futures had collapsed. The S&P 500 was headed for one of its worst days in years. When the opening bell finally rang at 9:30 a.m. Eastern, the carnage was instant. The Dow Jones Industrial Average plunged 1,700 points in the first hour of trading. The NASDAQ dropped 3.5%. The S&P 500 shed nearly 2%. But those percentages don't capture the scale of destruction. In total, over $800 billion in market capitalization was erased in less than 24 hours. That's more than the GDP of Switzerland. Gone. Not to another investor, not to another asset class. Simply wiped out. Apple lost $60 billion in market value overnight. Microsoft shed $50 billion. Nvidia, the darling of the AI boom, dropped $70 billion. Tesla fell $40 billion. The tech giants that had driven the market to record highs for years were suddenly bleeding. Pension funds watched their portfolios crater. Retail investors who had checked their accounts on Friday saw numbers they couldn't believe on Monday. The panic was real. The losses were staggering. And the question everyone was asking was the same. What just happened? The headlines blamed a disappointing jobs report. Others pointed to weak manufacturing data. Some cited fears about Federal Reserve policy. But none of those explanations captured the deeper truth. This wasn't about one data point or one policy decision. This was the inevitable consequence of a financial system built on a foundation that's been cracking for decades. A system where America carries $36 trillion in debt, where the Federal Reserve has printed trillions to keep markets afloat, where inflation has quietly eroded wealth while the national debt continues to climb, and where the only way out is a trick so subtle that most people never see it coming. America isn't paying its debt, it's erasing it. And that night, when $800 billion disappeared from the markets, we got a glimpse of what happens when the illusion starts to crack. To understand what happened on February 3rd, you need to understand what's been building for years. The United States national debt is now $36 trillion. $36 trillion. That number has become so familiar that we've lost the ability to comprehend it. If you spent $1 million every single day, it would take nearly 100,000 years to spend that much money. This debt didn't appear overnight. It's been accumulating for decades through wars, financial crises, tax cuts, stimulus packages, and political promises to spend more while taxing less. And here's the uncomfortable reality. America has no intention of paying it back, not in any traditional sense. Because when you're the issuer of the world's reserve currency, you don't have to. You can do something far more clever. You can inflate it away. This strategy goes back to August 15th, 1971, when President Richard Nixon announced that the United States would no longer convert dollars to gold. The Bretton Woods system died that day. The gold standard was gone. In its place emerged a world of fiat currency money backed not by precious metal, but by faith in the government that issued it. Nixon called it temporary. It became permanent. And it changed everything. Without gold as an anchor, the Federal Reserve gained unprecedented power. It could print money to fight recessions. It could lower interest rates to stimulate growth. It could expand the money supply with few constraints. And critically, it meant that America could borrow in its own currency and always have the option to print more money to service that debt. Default was theoretically impossible, but there was a cost. That cost was inflation. Here's how the trick works. When the government borrows $1 trillion today, that debt is measured in today's dollars. But 20 years from now, when that debt comes due, the government doesn't need to repay $1 trillion in real purchasing power. It only needs to repay $1 trillion in nominal terms. If inflation has been running at 3% per year, that $1 trillion in 2045 is worth far less than $1 trillion in 2025. The debt hasn't been paid off. It's been quietly eroded. The numbers on the ledger stay the same, but the value behind those numbers has silently disappeared. This is why the Federal Reserve targets 2% inflation, not 0. 2% sounds harmless, but compounded over decades, it cuts the value of money in half every 35 years. $1 today will be worth 50 cents in 2060. And everyone holding dollar-denominated debt, foreign governments, pension funds, retirees, savers, gets paid back in money that's worth less than what they lent. It's a hidden tax. Invisible, but devastating. And it's how America manages an unpayable debt without ever formally defaulting. But maintaining this delicate system requires balance. Inflation can't run too hot, or confidence in the dollar collapses. It can't run too cold, or the debt becomes harder to manage. And this balance is exactly what broke down in recent years. After the 2008 financial crisis, the Federal Reserve slashed interest rates to near zero and kept them there for a decade. Then came COVID-19. In 2020, the economy froze. The Fed cut rates to zero again and launched the most aggressive monetary expansion in American history. Its balance sheet exploded from $4 trillion to nearly $9 trillion as it bought bonds to stabilize markets. Meanwhile, the federal government unleashed $5 trillion in pandemic relief spending, stimulus checks, Paycheck Protection Program loans, enhanced unemployment benefits. Money flooded the economy. At first, inflation stayed quiet. Economists breathed easy. But by 2021, prices began to rise. By 2022, inflation was roaring. The Consumer Price Index hit 9.1% in June 2022, the highest level in 40 years. Gas prices surged past $5 a gallon. Grocery bills spiked. Rent climbed relentlessly. The cost of living was rising faster than wages, and Americans felt it everywhere. The Federal Reserve, which had spent months insisting inflation was transitory, was forced to reverse course. In March 2022, the Fed began raising interest rates, and it didn't stop. From near zero, rates climbed to 5.5% by July 2023, the fastest rate hiking cycle in 4 decades. The goal was to cool inflation by making borrowing more expensive, slowing spending, and reducing demand. But higher interest rates have consequences, and when you're carrying $36 trillion in debt, even small rate increases become catastrophic. In fiscal year 2024, the United States government paid over $1 trillion just in interest on the national debt. $1 trillion. That's more than the defense budget, more than Medicare. That's money that doesn't build infrastructure, doesn't fund education, doesn't provide services. It just services the debt. And here's the trap. The government can't afford to keep rates high for long because the cost becomes unbearable. But it also can't cut rates too quickly, or inflation roars back. The Fed is stuck between 2 impossible choices, and the financial markets know it. This is the pressure cooker that exploded on February 3rd, 2026. The trigger was a jobs report released on Friday, January 31st. The numbers came in weaker than expected. Hiring had slowed. Unemployment ticked up slightly. It wasn't catastrophic, but it was enough to shift sentiment. Investors began to worry that the economy was weakening faster than anticipated. If a recession was coming, corporate earnings would fall. Stock valuations that had been stretched to record highs suddenly looked vulnerable. But there was something else. Whispers had been circulating for weeks about stress in the corporate debt markets. Companies that had borrowed heavily during the years of zero interest rates were now facing refinancing at much higher rates. Some couldn't handle it. Defaults were creeping up. Credit spreads were widening. Bond investors were getting nervous. Then came the weekend. And over that weekend, algorithmic trading models, the machines that now dominate financial markets, digested the data. They saw weakness. They saw risk. And when Asian markets opened on Monday, the algorithms started selling. Tokyo's Nikkei dropped 2.8%. Hong Kong's Hang Seng fell 3.1%. The selling cascaded into Europe. By the time New York opened, the panic was global. The Dow opened down 1,200 points and kept falling. Circuit breakers, automatic pauses designed to prevent crashes, were nearly triggered. The VIX, the market's fear index, spiked to levels not seen since the pandemic. Traders watched in disbelief as $800 billion evaporated in a single session. But here's what most people missed. This wasn't just about one bad jobs report. This was about a market that had been propped up by cheap money for over a decade finally confronting reality. Stock valuations had reached levels that only made sense if interest rates stayed near zero forever. Price-to-earnings ratios were in nosebleed territory. Corporate debt had ballooned. And now, with rates at 5.5%, the math didn't work anymore. The stock market had been priced for perfection, and perfection never lasts. In the days that followed, the Federal Reserve rushed to calm markets. Officials hinted that rate cuts might come sooner than expected. The message was clear. Don't worry, we'll save you. We always do. And for a moment, it worked. Markets stabilized. The bleeding stopped. Investors convinced themselves it was just a correction, just volatility, just noise. But the fundamental problem hasn't changed. The debt is still $36 trillion. Interest payments are still over $1 trillion a year. Inflation is still above the Fed's 2% target. And the only way the government can manage this is to keep playing the same game: borrow more, print more, and let inflation quietly erode the real value of the debt. This is the unspoken contract at the heart of American finance. The government borrows to spend, the Fed prints to stabilize. And ordinary Americans, workers, savers, retirees pay for it through the slow, invisible tax of inflation. Your paycheck might increase 3%, but if prices rise 4%, you're getting poorer. Your savings might earn 2% interest, but if inflation runs at 3%, your wealth is shrinking. The money isn't disappearing into thin air. It's being transferred from creditors to debtors, from savers to borrowers, from the public to the government. And most people never realize it's happening. But the markets are starting to realize. That $800 billion that vanished overnight was a warning. It was the market asking a question. How much longer can this last? How much longer can the government borrow trillions every year? How much longer can the Fed print money without breaking the currency? How much longer can the dollar remain the world's reserve currency when the debt to GDP ratio exceeds 120%? And that confidence, the belief that the dollar will hold its value, that U.S. treasuries are safe, that America will always meet its obligations, is not infinite. Confidence is built over decades and destroyed in moments. Every time the Fed prints another $1 trillion, every time the debt climbs higher, every time inflation spikes and erodes purchasing power, that confidence is tested. The cracks are already visible. Foreign central banks, which have traditionally been the biggest buyers of U.S. treasuries, are diversifying. China has been reducing its holdings for years. Japan, America's closest ally, is slowly shifting reserves. Even oil-producing nations are beginning to accept payment in currencies other than dollars. These shifts are small, incremental. But they're real, and they threaten the fundamental privilege that has allowed America to borrow without limit. Some see cryptocurrencies like Bitcoin as a bet against this system. Bitcoin's supply is capped at 21 million coins. It can't be inflated. It can't be printed by a central bank. Whether it succeeds or fails, its very existence reflects a loss of faith in fiat currency, a recognition that money untethered from any constraint will eventually lose value. For now, the system endures. The dollar is still king. U.S. treasuries are still considered the safest asset in the world. But the night of February 2nd into February 3rd, when $800 billion disappeared, was a glimpse of what happens when the market loses faith, even briefly, in the illusion. Here's the truth that no politician will say out loud: America will never pay back $36 trillion. It can't. It won't. But it doesn't have to. Because debt measured in a currency you control isn't a problem, it's a tool, and inflation is how you use that tool. Every year that inflation runs above zero, the real burden of the debt shrinks. A $1 trillion deficit today becomes manageable when future dollars are worth less. The numbers keep climbing, but in real, inflation-adjusted terms, the debt becomes lighter. This is why the government will never seriously attempt to balance the budget. This is why austerity is always promised, but never delivered. Because in a fiat currency system, debt isn't a crisis. It's a feature. As long as the world believes in the dollar, America can keep borrowing, keep spending, and keep inflating away the real cost. But belief isn't permanent. And history shows us what happens when reserve currencies lose their status. The British pound dominated for over a century before the dollar replaced it. The transition wasn't smooth. It was marked by crisis, devaluation, and loss of power. Reserve currency status requires economic strength, military dominance, deep capital markets, and above all, trust. When that trust erodes, the fall can be swift. We're not there yet, but we're closer than we've ever been. The debt is unsustainable. The inflation is real. The alternatives are emerging, and the Federal Reserve is running out of options. So when you see $800 billion wiped out overnight, understand what you're really witnessing. You're seeing the consequence of decades of choices to borrow rather than tax, to print rather than save, to inflate rather than face hard truths. You're seeing a market that's been drugged on cheap money for years suddenly confronting withdrawal. You're seeing the fragility of a system held together not by sound fundamentals, but by shared belief. America isn't paying its debt. It's erasing it. 1 percentage point of inflation at a time, $1 trillion Fed intervention at a time, one market crash and rescue at a time. And that works until it doesn't, until confidence breaks, until the world finds another reserve currency, until the printing press finally destroys the currency itself. That night, $800 billion vanished. It was a warning shot. A reminder that markets can turn in hours, that wealth can disappear overnight, that the system we take for granted is more fragile than it appears. The next time, it might not be $800 billion. It might be 2 trillion. It might be 5. The debt isn't going away. It's growing. The only question is how much longer the illusion can hold.